What is skew and why does it matter? If you've never heard of skew, you might want to watch this video so you don't get screwed. I'm Bagadon at StockMarketCaddy.com. Today is December 15th and it's 1:35. Now we have been bringing to the attention of our members for years. We report on the skew every night. It's one of many various market indicators that we'll look at. But let me explain to you first what skew is, and then we'll overlay the S&P 500. Skew refers to the premium difference in call options and put options on the SPX 500. Boy, that's a mouthful. Let me explain. Let's say, for example, just for example, that the SPX index is trading at 100. If one was to buy a call on the SPX trading at 100 and they were to buy a call at 110, you might expect for a period of time, let's say it's for 30 days, you might expect that call to cost, we'll say for example, it would cost more than $10, but not much more. It might cost $12.50. Therefore, and a call is a bet that the market would be going up. If you were to buy a put at 90, basically equidistant, 10 points removed, right? The call was 10 points above the SPX price of 100. If you were to buy a put at 90, betting that over the same exact period of time, betting that the price would go down, you would expect, would you not, that the price of the put would be the same as the call? Approximately 10 points, tack on, a little bit of a premium. And if the call is $12.50, you might expect the put to be also cost $12.50. Well, the reality of it is, day in and day out, the difference between a put and a call, equally spaced on the, for lack of a better word, on the SPX, there is a skew. A skew. And that skew usually translates into a higher premium for the put. Usually. So if the call cost $12.50, the put ordinarily will cost something more, maybe 13 or 13 and a quarter. And the difference between that is referred to as the skew. Now, ordinarily, when the skew is at extreme levels, it usually indicates a contrarian move in the market. For instance, if the skew reading, and there's a skew index, which is what you're looking at right now, and the skew index is at 144.51. When the skew is very, very low, usually below 120, and in fact, let's put a horizontal line on here. When the skew is below 120, and we will color this, we'll just color this cyan for right now. The interpretation in general is that the market is frothy, that everybody is buying calls, nobody is fearful, and therefore that the market is probably a bit overdone, and as expected, you might expect the market to go the other way, that is, to have a pullback or have a correction. Now, when the skew is over at 130, that's the number we like to use, so we'll get this. This is right in here is, we'll get 130. Actually, this is, that's, yeah, believe it or not, that's 130. And we'll also color this cyan. When the skew is above 130, in general, the puts are extremely more expensive, more than usual, than the calls, and the market is overly fearful, and it being many times a contrarian indicator, the market might be set to rally, that people are unduly bearish. Now that's usual. But we've noticed something since really, well, it happened last December, January, February of 2018 when there was a big market correction, and we'll point this out. When the market is at its highs, you would expect, therefore, the skew to be very, very low. You would expect people to be very, very bullish and to be buying calls, selling puts, hand over fist. When the market is very, very high, and it's the reverse, they're selling calls and buying puts, the skew does what it's doing today, and it shoots up. What that means to us is that the smart money, and let me bring into view the SPX, is doing just the opposite of what the media and the talking heads would have you believe is going on in the market. Now we're going to paint the SPX a green line, and you're going to see, come into view here in a moment, the SPX. This is the S&P 500 matched with the skew. Now notice here, okay, this was back in September and October of just this past year. The market was headed down, very much so. Look at what the skew did. The skew was way, way down, meaning somebody, as the market was going down, was buying calls like crazy. They were doing just the opposite of what a normal market would do. They were buying calls. Same thing here. They were buying calls. And look what the market did from there. It ran up. When the market was up here, you had a higher skew, and they were buying puts or they were selling calls, and the market corrected. Look down here. The market, you would have thought, would have been very fearful, but yet somebody was very much buying calls. Now let's come back. I want to come back here, and you can see this was back, well, we had a big correction here, big spike in put buying, selling calls and buying puts, very defensive. We ended up having that correction. And the same was back here. What we want to show you is today, because we only have 10 minutes. Here is the market at all-time highs. The skew is going bonkers up. Somebody very, very smart, somebody very, very large is doing just the opposite of what the retail trader would be doing. They are selling calls and buying puts Why would they be doing that? It is their expectation that this market is about to have a very severe pullback. I'm Bagger Don at StockMarketCaddy.com. Feel free to check us out. Hope this helps. Don't get screwed by the skew.